Hey guys, welcome back to another video. Today we're going to be talking about expressions of interests, EOIs, and these are offers that you would submit to a business owner when you're interested in buying their business. And this is really the preliminary offer before a more formal and detailed letter of intent. And so I've already made a part one video on this topic covering the definition and giving you some examples in terms of mistakes to avoid and sections to cover off and comparing the differences between an EOI and an LOI. So I'd recommend you watch the part one video first, but this is the part two practical video. So this is a real life example of an EOI that was submitted by a private equity firm for one of our businesses. I've removed the names, obviously, of the clients and the buyers, but the concept in terms of the overall format and the items that are addressed in this EOI are real life examples of what a professional business buyer would submit to a seller. So in the first page, it's very similar to when you're applying to a job. It's really the cover page, summarizing the purpose of the offer, what you're looking to do, and then providing a bit of background and the investment rationale behind why this company interests you and why you're submitting an offer for the business. So right away in the first section here, you can see that you need to address what you're looking to do. I'm looking to buy 100% of the business, and I'm buying the shares of ABC Inc., the selling entity. That would obviously differ if you're looking to buy the assets or if you were looking to buy a majority control, 70, 80%, and the seller holds back 20%, right? Now, in the second section here, this addresses the background. And so I've kind of summarized, I've broken down the key areas of focus for most executive summaries that I see from buyers. And these are kind of the 5 topics that I look at. The first is the background on principles. We always ask, where are you coming from? What are you doing today? What's your previous management background? Have you owned any businesses in the space that you're looking to buy today, right? If I'm selling a HVAC business, have you ever worked in the HVAC space? Have you ever worked in anything related to contracting and service and more technical backgrounds? Well, allude to that experience and provide that background in this cover note. The second one is culture and values. You as a business buyer, what is your culture? What is your approach? What are your priorities? I'm looking to make sure that I transition your legacy. I'm looking to make sure that your name lasts forever, and this is the way to do it. I'm looking to grow, all of these different kind of things, really communicating your vision in terms of, culturally, how do you anticipate to buy and transition this business? The other one is relevant business investments. So trying to communicate credibility is critical on this first page. And one of the easiest ways to do that is to say, hey, I've bought a business before. Hey, I've transitioned or acquired a company before. So allude to those experiences and give it a general example, right? Give the name of the company that you work with. Give a general sense of how many employees there were, how many facilities did you manage and own, what was the general revenue level of that company, and just again giving some numbers really puts more meat on the bone in terms of the seller looking at that and saying, oh, that's a similar sized business to mine. Oh, he or she is going to have the ability to transition that business. The other one is the track record. With those businesses that you've owned or managed or grown, how have you done that? Was it acquisitions? Was it internal growth by releasing new products or expanding divisions? Was it making key hires and developing young talent? What are some of the ways that you've done that? So alluding to your management approach is critical, right? Because again, that seller is going to be working with you as you transition that business, so they need to understand your management style. And then the final thing is, why are you interested in this business? What really attracts you to submit an offer? Is it the growth outlook? Is it the industry? Have you worked in the industry before? Really, are you interested in retaining the staff? How are you going to grow the business? Kind of just some general comments on your outlook and your vision and your interest with regards to the company. And again, a lot of people skip this sometimes, but this is just important when you're trying to really frame the relationship with the seller to communicate your seriousness. Now, scrolling down to the actual EOI content side on the next page here, we'll jump into the first section. This is the structure of the deal. So very similar to the upfront portion here, where I've summarized what the intent of this EOI is. Now I'm giving you more detail. So I, as the buyer, am looking to acquire 100% of the business. The purchasing entity is going to be formed, and I'm going to acquire the shares of that entity and then amalgamate with that entity. So I'm explaining the structure of the buyout and this is important, especially when, you're not just buying 100%, but maybe you're buying 70%. And, the seller's going to stay on and invest alongside you. How does the seller invest alongside you? Is he buying into the equity box alongside you, or is he going to roll equity? How does that look? So alluding to the structure of the deal is important because obviously there's tax implications that the seller needs to understand. The second section is the valuation. And so I talked about this in my first video. An EOI, you don't have to give a specific value of the company. What you're trying to do is you're trying to provide some rough terms in terms of what you think the value of the business is based on your preliminary analysis, subject to more due diligence and you confirming the assumptions that were given to you. So typically it's expected that you have a range. And not a broad range, because if it's a very broad range, then the valuation is not meaningful, but a relatively tight range. So in this example here, buyer XYZ is prepared to submit an offer in the range of 4.5 to 5 times normalized EBITDA, which is $1 million. So this buyer has clarified their multiple range, what they view as the normalized sustainable EBITDA, and then that is the valuation methodology as to why the total offer value is $4.5 to $5 million, the total enterprise value. So they've broken down the multiple, the sustainable EBITDA, and therefore this is the total purchase price for the business. And the other thing that they've alluded to here is the company will be delivered on a cash-free, debt-free basis with an appropriate level of working capital to be assumed by the purchaser. So as part of this purchase price, as part of this 4.5 to 5 million that I'm giving you, you're going to settle all the debts, you're going to take out all the cash that's on the balance sheet, and I'm going to assume a normal level of working capital, accounts receivable, inventory, accounts payable, to sustain and support the business at this level. And so they've clarified right away that you're going to have to, let go of some working capital and let the purchaser assume that. But all the cash and debt on the books stays with you. So they're not assuming any liabilities. So the valuation is very clear. They understand the methodology. This is a very good example of I would have no follow-up questions if I was the business broker or the seller. I know exactly the way they're thinking through valuation. So this is clear to me. And the third section here is the structure. So again, the EOI, you're not looking for specific numbers, right? Because I haven't given you a specific value yet, but I'm giving you broad percentage terms of how I think the structure is going to look. So this buyer is saying, I'm going to give you 70% upfront in cash with a 20% seller note, a vendor take-back note, and then a 10% earnout, which an earnout is contingent on future performance, whereas a VTB is guaranteed and is more of a fixed loan between the seller and the buyer. So really, when I read this, I think there's 90% of this purchase price is fixed and guaranteed, with the balance of 10% performance-based contingent on future performance. So going into the first section here of cash, so the cash component of the deal will be paid on the closing, and they're alluding to how they're going to finance that cash. So we expect to fund the transaction with a combination of equity and debt. So they are going to take out debt financing. We have long-established relationships with many banks and expect to finance around 2.5 turns of EBITDA via senior debt. So in this example, that means that 2.5 times that 1 million EBITDA, or 2.5 million, will be financed by the bank, with the balance of the 70% being financed by the equity check. So say, for example, the purchase price is $5 million. 70% of 5 would be $3.5 million. So they're saying 2.5 of that 3.5 will be financed with bank debt. The balance of $1 million, the balance will come from our personal equity funds. So these are high net worth investors. They don't have to raise any financing. They don't have to do anything. They have the funds already available to close. And then lastly here, there's no anticipated holdbacks, meaning they don't have to hold back any of that 70% subject to 6 months of due diligence to confirm that inventory moves or whatever the case is. So they're very clearly explaining to you exactly what they expect to finance versus what they expect to put in on their own, and they're telling you where their money is coming from. So this is a very clear section. This is what you want to do. You want to eliminate the seller's concerns around your ability to close, where the money's coming from, how much debt you're putting on. Because from the seller's point of view, if you put on a ton of debt on the books, well then if this was 3.5 or 4.5 turns of EBITDA, That means you're putting in very little equity. So you as a new buyer have very little skin in the game if this company blows up. And B, well, I'm holding back 30% of my estimated value waiting for you to pay down the bank debt. But if you put on a lot of debt, then this 30% is at risk because there's more leverage on the books, straining the company's cash flow. So indicating debt and leverage is very important early on. And it really communicates your philosophy around how you fund transactions. Are you a very high leverage, high risk buyer, or are you a more conservative buyer? Now, going into the second section, which is the vendor take back note. So they're alluding to a 20% VTB. At this stage in the game, you don't want to get into too many details because you don't know how you're going to securitize the note. You don't know a lot about the underlying information. You've taken the assumptions that the seller's given you. The next step is to confirm those assumptions before an LOI. So all that we really care about as business brokers at the EOI stage is a high level terms. What's the interest rate? Is it amortizing? Is it non-amortizing? What is the term of the loan? And how are you going to pay back the vendor note, the seller loan? And so they've clarified that here. The seller note will pay 5% annual interest in cash on each anniversary date of the transaction, and it can be prepaid prior to maturity without any penalty. The seller note will be interest only for the entire term and will be payable in full at the end of the third anniversary. So what that means is that it's a 3-year note paying 5% interest annually. There's no amortization, so you're not paying down the 20%. The principal stays the same throughout. And at the end of the 3 years, so 36 months later, the full note is paid back in full. And then it also indicates here just some general structuring. The vendor note will be subordinated to all senior bank debt, meaning that the bank will have first priority on cash flow and the seller will have a second position security on the business because of this loan, but they're subordinated to the bank. And then as well, they're nice enough to give confirmation that no dividends to the shareholder group will be paid until the outstanding seller note has been paid in full, meaning that they're not going to rip cash out of the business. If they have excess cash, they'll take that cash to pay down the VTB first before the new owners, start realizing money within the business. And this is rare. I sometimes see this if the buyer's really nice, but other buyers will not give this up, and you typically want to hold on to the dividend flow in the interim. So the key terms in the VTB section are rate, the term of the loan, the amortization, and just general security and structure comments. If there are more special conditions like accelerated payments, performance-based type variability to the value of the note, those things can be alluded to at this stage. But again, you don't want to get into too many details because again, you haven't spent that much time to really give a really good detailed offer yet. This is just an EOI. So going down now to the 10% earnout. So in this example, this is a really good example of I don't know enough about the business to give detail. So the purchase price will include a 10% earnout earned based on agreed upon gross profit targets to be determined at a later date. So they've given you a high level of how the earnout's going to get calculated. It's based on gross profit targets. We know what the amount is. We know that it's payable at the end of the third year, but the actual targets and the mechanism for calculating those targets and all that will all get addressed at a later stage at the LOI stage. Again, right now we just want very high level terms. So this is enough for the seller to make a decision and say, am I comfortable, A, in accepting gross profit targets? Should it be revenue targets? And then B, am I comfortable in waiting 3 years for performance-based earnouts? Or should I get more of that performance-based compensation earlier and sooner than the vendor note? So these are some of the considerations to think about. Now, in this example for this company that this EOI was submitted for, management were open to investing in the equity box. So, the seller was alluding to the employees and the management team, the senior staff of the business coming in. So they were confirming that, yes, we are open to that and that we will set up a structure to allow the management team to come in and buy the equity box, buy a piece of the equity box. So this is a good thing if the seller wants it. And in this respective example, that the seller did want the management team to go in. So, when the seller saw this, they're like, okay, great. They're addressing my needs. They're addressing what I'm looking for. So this was a specific seller need for this example. Now, in this example here, the seller owned the property. and the buyer was not looking to buy the property, they were looking to lease it. So in this scenario, both parties will agree to a market lease rate for the vendor-owned property for an initial term of 5 years with an option to renew for another 5-year period. The market terms will be determined at a later stage before a final LOI has been submitted by the buyer XYZ. So, really at this stage in the process, you're communicating your intent around the property. Do I want to buy it or do I want to lease it? And just the general structure around the term of that lease. It's a 5+5. It could be a 2+2. But discussing market terms and more specifics around, TMI per square foot and all that, that is just not needed right now because, again, you're agreeing to the high-level structure, not to the specifics. That's saved for the LOI, as they've alluded to here. Now, the next section is working capital. So same thing. You're agreeing to the structure, not the specifics. So assumed net working capital will be based on a normal historical level of net working capital in the business on a cash-free, debt-free basis. The target net working capital will be calculated using the trailing 12-month average of net working capital. So what that means is that they're going to take the last 12 months of monthly balance sheets as of closing, and they're going to calculate the net working capital, and that's the target that they're going to use for normal level of working capital that's assumed. Anything in excess or below that is an adjustment up or down to the purchase price. So say, for example, there's a lot of net working capital on the balance sheet in excess of what's needed. Well, then the seller has invested real cash into working capital and they're owed an excess amount. So anything above the target gets paid as a purchase price increase. But say, for example, the seller drains the net working capital before closing and is below the required level, well, then that deficit needs to be funded by the seller. And that's typically addressed through a purchase price payment adjustment down, right? So right now, at this point in the process, we don't want to talk about what the actual required net working capital is because the buyer hasn't spent enough time, but they're giving you their high-level methodology as to how they're going to approach net working capital, which is all that you need at this stage in the EOI. Now, the next section is the due diligence. So this section really addresses what do I need as the buyer to complete between the EOI stage and the LOI stage to give you a formal offer to close this transaction. And so they're listing out, management meetings, reviewing material contracts, doing operational due diligence, touring the site and seeing the facility, understanding health and safety and all those kind of things. Details on the historical financials, really going into the P&L and the GL and understanding really key customer or a cost or revenue accounts. Doing market, customer, supplier, and brand due diligence, completing a quality of earnings by a third-party accounting firm to substantiate the EBITDA, and then last here, other elements of due diligence that may arise during that process. So they've given you a laundry list of things that you need to complete and help them complete before they can submit an LOI and close a deal. So they're managing the seller's expectations to say, this is what I need. So start getting ready if this EOI is within range and we're going to proceed forward. So this is a really good way to, from the seller's point of view, to prepare themselves and the resources to deliver this information. And then in this last sentence, they're saying, we expect to be in a position to sign the purchase agreement, which is the final legal agreement, and close within 90 days after the acceptance of our LOI. So not only are they saying, what do I need between the EOI and the LOI, but they're saying, once we sign that LOI, it'll take us 90 days to close this transaction. So it's a really good way to manage seller expectations around timing and what their workload is going to look like in the coming months. And then the last two sections, you always want to see these because you don't want it to be binding. But the first one is confidentiality. So making sure that, without any prior written consent by the buyer, that the company, the vendor, and the agents of the seller, the financial advisors, the accountants, are not blanketing and openly sharing this offer and not discussing the terms of this offer openly with the marketplace, that everything that's within this piece of paper and the interest of the buyer is confidential and only between the seller and the buyer. Then as well, this is a non-binding agreement, which means that the EOI is a non-binding commitment. There's no sign back, there's no nothing else. This is really just a discussion paper, and it does not bind the buyer to go through and buy this business if they go and find, some skeletons in the closet and want to walk away. So these are typical terms, boilerplate clauses that you'd see at the end of an EOI. And that's it. that's really the end of it. So there's no signing authorities. You don't have to sign anything. It's really just a high level document giving you the key building blocks of what an LOI looks like early on in a discussion. And so as a broker, what I would do is, I would look at these assumptions, and I would look at, the financing and the equity requirements, and start asking key questions. A, is this buyer serious? B, are they professional? Looking at their cover note, are they professional operators? Can they transition this business? Is the transition risk high, and therefore we don't want to accept a lot of deferred compensation? We want to see more cash up front to eliminate the risk of not getting paid in the future. Is the valuation range correct? Is it appropriate? Do I agree? If we said that the EBITDA is 1.2 and the buyer says, well, no, our valuation methodology is 1, I would pick up the phone and say, Mr. Buyer or Mrs. Buyer, why is the EBITDA only 1 in your offer? Can you walk me through that? So these are the building blocks that allow for that discussion to happen. And so when you see a buyer put together a formal offer like this, it takes time, it takes a lot of research, and it shows a genuine interest in the company. So it's a really good sign, and it's a great roadmap to really help the seller and the buyer walk from the starting discussions all the way to a formal offer. So this is really a good example of an EOI. If you have any questions or comments, please comment in the comment section, and happy to get back to you. If you found the video helpful, please do like and subscribe to the channel. I appreciate all the support, as we continue to grow as a channel. And then as well, if you have any questions or, are working on a transaction yourself and you need some guidance or advice, my day-to-day business is I sell businesses up here in Canada. So happy to, get on the phone or, connect over LinkedIn and talk through the transaction with you. So feel free to reach out and connect with me over LinkedIn. So thank you guys so much, and have a great day. Thank you.